Every year, governments lose trillions of dollars in tax revenue, not because people can't pay, but because they choose not to. Hidden offshore accounts, shell companies, fake invoices, crypto wallets that don't show up on any tax return. Tax evasion is not a victimless crime. Every dollar hidden from a tax authority is a dollar taken away from schools, hospitals, roads, and public services. And in the eyes of the law and global regulators, like FATF, it is treated the same as drug money. In this video, we are breaking down exactly what tax evasion is, how it differs from legal tax avoidance, how it connects to money laundering, and what financial institutions are required to do when they spot it. Whether you are in banking, compliance, or just want to understand how the financial system really works, stay with us. This one is important. Tax evasion. The illegal non-payment or deliberate underpayment of taxes owed to a government, a designated financial action task, force predicate offense that generates criminal proceeds subject to ML obligations. The critical distinction: evasion versus avoidance. Tax evasion, illegal. Deliberately concealing income or assets from tax authorities. Examples: hiding offshore accounts, underreporting income, using shell companies to conceal assets. This is a crime. Proceeds are criminal and subject to money laundering reporting obligations. Tax avoidance, legal. Using legal provisions in tax law to minimize tax liability. While legal, aggressive avoidance schemes may attract regulatory scrutiny, does not generate criminal proceeds, no money laundering obligation triggered solely by avoidance. Tax evasion versus tax fraud. These terms are often used interchangeably, but carry a subtle distinction in some jurisdictions. Tax evasion refers to the deliberate non-payment or underpayment of tax. Tax fraud is the broader act of actively deceiving a tax authority. For example, submitting falsified returns, fabricating deductions, or creating fictitious invoices to claim refunds that are not owed. In practice, most tax fraud involves evasion, and both generate criminal proceeds subject to money laundering obligations. How tax evasion connects to money laundering. When FATF added tax crimes as a designated predicate offense, it created a significant new compliance obligation. A financial institution that identifies a customer concealing assets from tax authorities may have an obligation to file an SDR, even if no other financial crime is apparent. The undeclared funds are criminal proceeds in the same way that drug money is. The 3 stages applied to tax evasion. Placement: undeclared cash from underreported business income is deposited into a bank account in small amounts to avoid detection thresholds. This simultaneous structuring makes the placement stage particularly visible to financial institutions. Layering: funds are moved through a series of shell companies, offshore accounts, or nominee-held trusts across multiple jurisdictions, making it difficult for tax authorities to trace the origin. Layering in tax evasion often mirrors the same techniques used in other ML schemes. The difference is the predicate offense, not the method. Integration: once sufficiently obscured, the funds re-enter the legitimate economy. Common integration methods include real estate purchases, luxury asset acquisition, investment in legitimate businesses, or loans from offshore entities back to the evader, a technique known as a loan-back scheme, where the criminal effectively borrows their own illicit funds and claims the repayments as a legitimate business expense. Common typologies. Offshore account concealment. A customer holds an undisclosed foreign bank account through a shell company, routing income offshore before it can be taxed. The account may be held in a secrecy jurisdiction, historically Switzerland, now increasingly the UAE, Singapore, or Caribbean jurisdictions, with no disclosure to the home country tax authority. Cash business underreporting. A business owner underreports cash sales and deposits the unreported cash in small amounts to avoid detection. This is simultaneously tax evasion and structuring, 2 separate offenses arising from the same conduct. Layered trust structures. A high net worth individual uses layered trusts across multiple jurisdictions to conceal beneficial ownership from their home country tax authority. The complexity of the structure makes it difficult to identify the ultimate taxpayer, which is precisely the intention. Loan-back schemes. The evader moves funds offshore, then takes a loan from their own offshore entity back to themselves or their business. The loan appears legitimate on paper, repayments are treated as deductible expenses, and the offshore principal is never repatriated or taxed. This is one of the more sophisticated integration techniques. Fictitious invoicing and trade manipulation. Businesses inflate import costs or deflate export revenues on invoices, a form of trade-based money laundering that simultaneously evades tax and launders proceeds. Common in jurisdictions with high import duties or where transfer pricing rules are weakly enforced. Cryptocurrency and digital assets. An emerging typology. Taxable gains from crypto trading are concealed by transacting through decentralized exchanges or privacy coins, making it difficult for tax authorities to trace profits. Some individuals receive income entirely in crypto and never convert to fiat, attempting to remain outside the reporting system altogether. Red flags, tax evasion in a financial institution context. A customer's lifestyle, assets, or spending patterns are inconsistent with their declared income or tax profile. Large or frequent cash deposits across multiple branches or accounts just below reporting thresholds. Consistent with structuring. A customer who operates a cash-intensive business but shows unusually low declared turnover relative to transaction volumes. Frequent transfers to or from secrecy jurisdictions with no clear business rationale. Complex ownership structures involving multiple shell companies, trusts, or nominees that obscure the beneficial owner. A customer who receives large international wire transfers described only as loans with no supporting documentation. Reluctance to provide source of funds documentation, particularly where funds originate offshore. Use of cryptocurrency wallets or exchanges with no clear linkage to declared income. Key international frameworks. Financial Action Task Force Recommendation 3. Designates tax crimes as predicate offenses for money laundering. Applies to both direct taxes, income, corporate, capital gains, and indirect taxes, VAT, customs duties. This means proceeds of tax evasion are treated as criminal proceeds in the same category as drug trafficking or corruption proceeds. OECD Common Reporting Standard, CRS. Launched in 2014, the CRS is a framework for the automatic exchange of financial account information between participating tax authorities. Over 100 countries participate. Financial institutions in participating jurisdictions are required to identify account holders who are tax residents of other CRS countries and report their account details, including balances, interest, dividends, and proceeds from asset sales to their local tax authority, which then shares the data with the relevant foreign authority. CRS has significantly reduced the viability of simple offshore account concealment. FATCA, Foreign Account Tax Compliance Act, USA. Enacted in 2010, FATCA requires foreign financial institutions worldwide to identify and report accounts held by U.S. persons to the U.S. Internal Revenue Service, IRS, or face a 30% withholding tax on certain U.S. source payments. FATCA operates through intergovernmental agreements, IGAs, with over 110 countries, and has effectively made it very difficult for U.S. taxpayers to conceal offshore assets from the IRS. It also served as the template for the later CRS framework. The EU Anti-Tax Avoidance Directives, ATAD I and II. European Union directives targeting aggressive tax avoidance and hybrid mismatch arrangements used by multinationals to shift profits to low-tax jurisdictions. While focused on avoidance rather than evasion, they signal the direction of travel. Regulators are increasingly unwilling to tolerate the grey area between the two. DAC 6, EU Mandatory Disclosure Rules, requires intermediaries, lawyers, accountants, tax advisors to report potentially aggressive cross-border tax arrangements to tax authorities, expands the compliance perimeter beyond financial institutions to professional service providers, reducing the ability to structure evasion schemes with professional assistance without detection. The Pandora Papers, Panama Papers, and FinCEN files. While not legal frameworks, these major data leaks have had a significant regulatory impact. They exposed the widespread use of offshore shell companies and trusts by high-net-worth individuals, politicians, and corporations to conceal assets and evade tax. Each leak accelerated regulatory reform, beneficial ownership registers, CRS participation, and stricter EDD requirements on PEPs and offshore structures all gained momentum in their wake. The compliance obligation for financial institutions. When a financial institution identifies indicators of tax evasion, the obligation to file a suspicious transaction report, STR, is triggered regardless of whether the institution is itself involved in facilitating the evasion. The key test is whether the institution has reasonable grounds to suspect that funds represent the proceeds of a tax crime. This places a significant responsibility on compliance teams to understand tax evasion typologies, not just traditional ML red flags. Practically, this means CDD and EDD processes must include assessment of whether a customer's declared income and tax status are consistent with their transaction behavior. Source of funds and source of wealth documentation must be scrutinized for offshore structures that may indicate concealment. Correspondent banking relationships must consider the tax evasion risk profile of counterparty jurisdictions. PEP screening must account for the elevated risk that public officials may be concealing corrupt income from tax authorities in addition to AML risks. Tax evasion is not just an accounting problem, it is a serious financial crime with real consequences. When individuals and businesses hide income, the entire system suffers. And with frameworks like FATF, CRS, and FATCA now connecting tax authorities across more than 100 countries, the walls are closing in on those who think they can hide. For financial institutions, the message is clear. If you see the signs, you have an obligation to act. File the STR, ask the questions, look beyond the surface. If this video helped you understand tax evasion and its connection to money laundering, hit that like button and subscribe for more financial crime and compliance content. Drop a comment below. What topic should we cover next?